Valutrades, Forex CFDs and commodities.
So I think the topic is quite pertinent and one of these evergreen topics, right? Trading first on a demo account and when transition into the live trading. First things first, we have a special guest here, professional trader from Germany. Daniel Schütz has kindly agreed to come over to London to participate in tonight's exclusive webinar where we will talk about his transition a little bit. Obviously, I'm happy to share my and others' experience I'd be talking to. But let me introduce Daniel.
Thanks for having me here. Hello.
Yeah, you're very welcome. If you have any questions, obviously you can use the chat functionality. And if that video or recording of the webinar prompted any questions, please feel free to reach out via the colleagues from Valutrades. Very happy to pass on the messages to me or to Daniel for that matter, to get an insight in how do you actually hopefully successfully navigate that move from demo account to live trading. Look, but before we go into that, the professional thing to do is also to talk about a risk disclaimer. Trading CFDs comes with associated risks. You can lose your invested capital. These are highly leveraged financial instruments. That means that you can actually accelerate the depletion of your trading account. It does not only work in your favor, it also would work against you. If you have any questions about that, please do talk to the account representative at Valutrades. And bear in mind that everything we discuss is purely educational character and nothing should be seen as an explicit buy or sell recommendation. You and yourself are responsible for your trades. So it's an important comment. Look, and if you've been in a situation where you lost trades, right, and you will know how important it is. But the point here is really to help you, i.e. lose less. That would be a good starting point, but also hopefully you become a better and more successful trader. And who else when kind of Daniel would be in a good position to comment on that, given that he's done exactly that. He's living the virtual dream, right? So you are somebody who is not bound by going to the office every morning. You can work from home,
Yeah.
Just lying on a sunbed and enjoying life. Oh, there's even a sunbed picture. How did that happen? So how's living on a beach?
It's really nice. You can do what you want. No, most people think of having a leisure life and do what you want with no rules, and people are always excited if you tell them you're a trader, you trade for a living, and yeah, but trade for a living, it's different. Trade for a living, you have to have a really structured life, a really structured working day every day. You have to be real passionate for what you're doing, but it gives you all the freedom you want to have. You can trade from nearly every country, nearly every place, nearly every beach or whatever you want to do. So it's a really cool life. Yeah,
that's great. So you're living the dream, but to kind of inject a dose of reality into the whole thing. When you transitioned for yourself into the professional trading arena, do you only spend a couple of hours on learning trading, or was that somehow different?
It's like learning your job, like going to university or whatever. You spend several years to do your degree on university, and it's nearly the same if you want to try to learn how to trade like a professional. It takes not only weeks but years you have to spend with education and trying to do the business, trying to get into the business.
So the bad news here probably then is I don't know if you've ever read Malcolm Gladwell's book Blink, where it's talking about the fact that we are able to make unconscious decisions. And if you kind of look at the root cause that he's using, he says you are able to make intuitive decisions, we say Bauchgefühl in German, based on the fact that you're an expert in something. And when he refers to some Swedish research, where you say to become like an expert violist or another musician, you probably need 10,000 hours to learn something. Is that also true for trading?
It's true. It's definitely true. And there's another book I want to recommend. It's Trading from Your Guts. It's from Timothy Ferrier. No,
Okay.
it's from help me out, please. The Turtle Trader.
Oh. No, I'm standing on.
But it's a really nice book. Trading from Your Guts. It describes how you can do trades if you feel the markets must go in some direction. Curtis Faith. Yeah, that's one. I mean, really nice book, really.
Okay, so that's so. First of all, we can summarize. Unfortunately, no shortcuts, right? Trading for a living means that you have to spend the time learning trading, but as we also heard from our pro trader here, it's quite rewarding experience.
It is.
Once you've made that transition. So let's explore that transition period and the life a little bit more. So you highlighted the whole point of work-life balance. What do you mean by that?
It's different. The motivation why people get into the trading business is, at one hand, it's making money. That's definitely one part of it. The other part is the work-life balance. So do you want to spend your whole day working at an office or in front of a computer or whatever, or do you want to have the life, the real life, and enjoy life and have a little bit of working and the rest of the day to do whatever you want? And that's some point trading gives you the opportunity to do so. You have the chance to do your trade, to get into the markets in the morning and to get out really early. For example, you get into the markets at 9 o'clock in the morning and you close your trade at 11 o'clock. So you have the rest of the day to do whatever you want. You can spend that part of it to educate yourself in trading, and the rest of the day, enjoy life. And that's one of the biggest point you can you do by trading. You can trade from every part of the world you want to do. For example, if you're in London, if you're on holiday, if you're wherever, you can do the trading business.
Yeah, and I also heard a lot of traders, including myself, who like to trade the open of the market, right?
Right.
You get some good volatility. You can get some sequences if you're good at trading them that work well for you. But also know professional traders who sit like what's probably the best animal to compare, like cheetahs, right? They sit in the grass for a very long time, and then they run very fast and they hit very hard, and they're very successful. But in fact, the most successful traders I know are able to sit for hours in front of the screen like a cheetah and then hit very hard once their pattern emerges, right? Whatever that pattern actually is. So let's dive into the whole scenario a little bit, and we had a bit of a discussion of that already, but also for the benefit of our participants here. What do you mean by diving in?
Diving in, one of the biggest mistakes trading newbies do is just to dive into the whole thing. They learned about trading is a very interesting job. You can earn a lot of money with that. You don't, and all that stuff. And then they open an account and they just dive in without any knowledge. And that's one of the biggest mistakes you can do. We talked about trading is a hard business, and you have to learn it. And so you need a lot of knowledge. You need to gain a lot of knowledge before you can earn money out of that business. And so before you start, get that information you need to learn, you need to do. So for example, risk and money management is one of the most important things you have to learn. And just don't dive in, know what you do.
Right. That's a really good point. Sorry for putting you on the spot quite a lot. That's what you're here for, and I think that's what everybody's interested in a way. Everybody asks me that question: where do you get your information from? Is it was it the right books? Is it have you met a right mentor? How did you get kind of access to the whole trading arena?
I think these days it's really easy to get the information. You have all the social media. You have the yeah, the whole internet stuff where you can connect to the people. In former days, it was really hard to get those informations. You have to teach yourself, you have to read the books, you have to visit traders, well-known traders, to get informations of them, how they do the business. Yeah, but at the moment you can meet people, you can connect, yeah, like via Facebook or whatever. You can exchange, and then you can meet those people. And there's one thing I like. Get out to the people who really trade and meet them and talk to them. Sit in front of them face to face and hear what they say and learn. Every day you can learn from a trader.
That's a good point. Just a side comment, probably from my side there. If you happen to be based in London, for example, or a place like Dublin, my good friend Paul Wallace, who's also running webinars here from time to time, or for Valutrades. He runs Traders Drinks, and that's easily a pub full of 100 people, like-minded people, and it's just a great opportunity not just to socialize, but also to create a bit of a buddy network, right?
Really, that's very important.
It's very powerful, and I'm sure in the city where you are, there is probably some sort of association for private investors where you can sit down and again share some thoughts and socialize a little bit, because that's probably not on that slide, but it just kind of comes to my mind. Trading can be quite lonely, right? And
it can be.
How do you deal with that?
Networking is one of the most important things, that you get in touch with other traders and exchange your thoughts on the market, exchange thoughts on a new indicator or whatever. That's one of the key points, because nobody tells you what's right or what's wrong. Only market tells you. If you look at your account is up or down, so you know if you're right or not.
Yeah. So I think that's another advice in general that I take from what he just said. When you are trading, try to make sure that you have a bit of a social network around you, because otherwise nobody will give you that pat on the shoulder if you had a good day, or nobody will kill you if you had a bad day if you don't tell anybody about it. Right? We all been there. So that's something where you can create some, I call it accountability. Where you say, for example, you have a trading buddy, and at the end of a month you share, and that can be a quite brutal experience. You share your P&L and how the month went to your trading buddy. But only with that, you probably can become a better trader.
Okay, one of the most important things is, if you're a professional trader and if you work in trading business for a company, you have a risk manager.
Yep.
If you're at your own and you trade your own account, you don't have any risk manager that puts an eye on you. You're fully responsible for everything you do, and you have to be totally honest with yourself. And that's one of the hardest things to learn if you get into the how you can tell that self-employment in a trading business. Be honest to yourself.
Yeah, and now you shocked me with that slide when you proposed that slide.
It's nice. It's a nice picture, isn't it?
It's a very nice picture, yes, but it says no rules. And I always thought everything in trading is about rules. And now you show me no rules and a beautiful lady with a laptop. Is that
no
shooting from the hip?
No rules is what most people think. If you tell them you're a trader and you do trade for a living, you can get up every morning. Doesn't matter what time, you can do whatever you want. If you have a hangover, then you just start at afternoon or whatever. Yeah. So that's totally not true. There's no other business in the whole wide world where you have to be so patient, where you have so disciplined to make your living. I think if you ask me what trading comes down to, it's risk and money management and discipline. So you need rules. You definitely need rules, and you have to structure your day. You have to structure when you get up. You have to structure what's the first thing you do if you get to the computer. You have to know what happens this week. You have to know what happens this day, and you have to structure all those things.
So maybe on a side note, also again from my good friend Paul Wallace, a tip here. What he does before he starts his trading day, he scores himself. Like he has 4 or 5 categories, which include like, did I drink yesterday evening too much? Do I have any stress in my life right now, which
Okay.
is beyond the normal level, right, and so forth and so forth. And if he doesn't score enough points on that day, he takes himself out of a trading market for the day.
Okay, that's a very, very good tip.
Mm-hmm.
I always do it after the trade, but to do it before you start with the trading day, it's
This is hygiene factor check if he's kind of ready to play with the big boys, because as you pointed out many times since I got to know you, trading is always, when you go to the market, you always you play against the sharpest and the best and the brightest, right? And
there are only sharks out there.
yeah, exactly. Yeah. And if you bring your B or C game and not your A game, well, odds are that your trading performance doesn't stack up.
That's right. Yeah.
So what's interesting to see, everybody has a different rhythm. So Paul has this kind of overarching scoring mechanism. You look, can you just explore that a little bit? You review a trade after?
I rate every trade I did, and those factors you just mentioned. It's very important. If I see a trade was not running very well, then I ask myself what could be the reason.
Yep.
Maybe I have hangover. I was drinking last night. I had some argue with other people before I get into the trade,
yep.
or whatever. I didn't watch the news or so on.
Yeah.
But I do it afterwards.
Yeah.
To do it before that, maybe the better choice. So I have to think about that. Yeah.
See, I think that's something that probably combines all smart people in general, not just traders. It's just to be curious, and if something works for you, add it to your portfolio. If it doesn't, then probably not.
Right.
So entrepreneur, that resonates very strongly for me, because I think I have that mindset and kind of always wheeling and dealing and trying something. And you're definitely the same person, always trying something out and never shy to also take a risk. But what is that entrepreneurial perspective or behavior or mindset? That's the word.
Yeah,
what does it represent?
It has all to do with the mindset, how you go into the trading business. Before you go there, you have to have the mindset that you start your own business. Trading is my business, and I do trade for a living. And that's what you should be aware. Every day you get into the market, and you have to feel like a startup entrepreneur, or you have to get that feeling that you want to run a business. It doesn't matter if you do trading by part-time or full-time, whatever. Every time you get into a trade, have that mindset up. You are a trading. You run a trading business. That's the word I was looking for. Yeah.
Okay. And that sounds awfully boring, right? I thought trading is exciting.
Trading is a business, and it's the most exciting thing you can do.
And the exciting part is that it's boring, or what?
I think every business has a boring part. So maybe you have to wait a little bit until you get into your trades, but afterwards, the reward is very good.
I say it deliberately and a bit on it from a challenging point of view, because I suppose what's important in trading, especially when you and I've talked to so many traders about this, when your position size gets bigger, right?
Oh yeah.
And you get too excited about it, then odds are that you make a bad decision at the end of the day. That's why a lot of people say, and they simplify a little bit, obviously, is that the best traders make trading really boring at the end of the day. But the point is more around being able to very mechanically, also with larger position sizes, to execute and manage risk, right?
Okay, what helps is to make a checklist. You just said trading is boring, and if trading is boring, it can bring you to some, how we call it, routine that makes you making mistakes. And so just try to set up a checklist every day. Did I check the news? Did I check the trend? Did I check whatever comes up these days, the next days? When is the next Fed meeting or whatever? So you have to be aware of that. And then checklist helps to structure your day and to structure the trading. So it never gets boring.
That's a good point. Let me just summarize it also in a way that if you do the same thing over and over again and it doesn't give you a good result, right? And then you should probably try to change it. And what I've seen a lot of traders who get too excited and have too much risk, right? And can't really manage that. for them it's a bit of like Groundhog Day, right? The movie.
Right.
Every day you wake up and you go through the same negative experience. And there was one guy actually, he was interviewed in Trading Wizards. His name was Ed Sikota. And
Yeah, right.
Ed, one thing that really stuck with me was he said, the market will always give us what we believe and what we want. And he went on to say, we often believe that we're really bad at trading. We're really bad traders. And the weird thing that happens is that you get that unconscious belief confirmed by losing.
Yeah, right.
Which is one of the weirdest thing ever, because you get your happiness by losing, and that definitely is a recipe for disaster. And that's what I think also what we're trying in this webinar and video, try to help you to, if you feel like you are a bad trader, we try to give you a bit of an idea and lend you a hand of an olive branch to get out of that rut. So let's move forward. Only the best.
Yeah, we already talked about that. There are sharks out there, and you are in competition with those sharks every day. And so if you don't feel like trading this day, you better don't trade. So every trade you do should be a good trade, and don't just get into the market because you feel like something. Get a setup and trade that setup. Make your plan and trade your plan. So,
and what are for you? We partly touched on it already, but what are for you the characteristics of a good trade? After you looked at a trade, what makes you happy? And you said, I've done well.
Yeah, if I follow my rules. So it doesn't matter if you win or lose with that trade, but if you follow your rules, if you that's one point. As a trading newbie, you have to learn that losing is part of the trading business, and so don't be afraid of losing, as long as the losing is within your rules. But be afraid of losing without your rules. So if you expand the losings, or how can you tell that? If you expand the losses outside of your rules, that's the most dangerous thing you can do.
Yeah. So let me just summarize that. So what you're saying is follow your rules, stay within your risk and money management parameters, and the worst thing that can happen is if you incur excessive losses, right? And I think Marty Schwartz always said, like, there's only three things important in trading: cut your losses, cut your losses, cut your losses, right? And you should not ever get your losses out of hand. And if you probably had a trading account for a couple of years, you probably encountered a situation where that has happened. But that's the whole point. You should not get into that situation. Let's just kind of move on. I think that I found that quite intriguing, the 7 sense thing. So we talk about rules a lot. We talk about being factual, objective assessment, filtering news out if you have a very tight strategy, all that. So that all sounds very fact-driven by me. And then for me, and when you talk about 7 senses, what do you mean?
Yeah, it's more a mental thing. Like we talk about that you should feel like an entrepreneur, and you should go on with that. If you have skills in setting up a business, then go on with that. Go to management seminars or get those knowledge the managers have that helps you in trading. For example, get into the whole tax thing. If there's something you can do better, or if there's only a thing you can do better in structuring your working day or whatever, go on for that and think like an entrepreneur and get a sense for that.
No, that makes total sense. And I think probably let's land on. I'm just looking at time. Let's do the following, if that's all right for you. I know you've done really good work, and you articulated 4 trader profiles.
Yeah.
Which I think are really, really interesting and quite easy also for people who either join the webinar or watch this as a recording can probably relate to. Don't worry, there's a little bit of a movie that's happening right now because I'm skipping a bunch of slides. well, some slides I want to stop, but I can't. All right. So moving on from the business plan part, I'm happy to introduce that if you want, because I heard the story from you, and want you to spend a bit more time on the actual profiles then. So just to give you an idea of how the pros do and how we kind of how level the playing field can be. There was an analysis done, a test done, an experiment in 1993 in Sweden, and they picked 5 analysts in this well-recognized scenario, and the analysts were supposed to trade their 10,000 Swedish krona account by doing what they always do, doing a market analysis, right, and picking the right stocks and bet on some winning themes, hopefully, and make some money. And the best out of the 5 analysts managed to yield about 10% in performance, right? So he got the account up from 10,000 to slightly above 11,000. But interesting, Ulla, our good friend Ulla, is a monkey, and a monkey that just threw darts at post-its, and the post-its had the name of Swedish stocks, right? And so he completely randomly picked stocks with his darts, the monkey strategy, and a well-known one. And interesting enough, when you look at Ulla's performance, that was much better. So he got 11,542 kronas, and nobody can imagine that the monkey, the chimpanzee Ulla, had a master in financial management and did anything else to understand the capital markets. So that's quite interesting. I guess the market was probably in a general up direction in 1993 when they did that, right?
Yeah.
So it was quite interesting to see that he outperformed the analysts. So what would you see as the key takeaway from that story?
I think as we can see, the entry of a trade is not very important. You can throw darts or you can do your analysis. You have no control of the outcome of a trade. But what you can control is the risk you get into that trade. So if you concentrate more on the risk and money management, you have better chance to survive in the markets. Most of the traders, they try to find the holy grail in trading by some indicators or whatever. They show them the entries into the market, but that's not so important. More important is really to manage the trade, to know when you have to get out of that trade, and to do all that stuff in the risk and money management, because that's all you can control.
Really powerful stuff, and I'm quite grateful that you brought the 4 trader profiles to this webinar, because I think again they're very relatable. You maybe want to see which trader type you either you are that perfect match to the trader type, or which trader type you correlate most with, and then we can give you an idea which trader types have most likely success in the markets, and which are ones that most likely will just burn capital in the short or the long run. So let's have a quick look at that. So you talk about 4 types of traders, and the first one is the so-called loose passive trader. So who the hell is the loose passive trader?
Yeah, he's loose and he's passive. That means that he sees opportunity, a lot of opportunities. But he doesn't follow through. That means maybe in the morning he sees a short opportunity, then a long opportunity. He just gets into a lot of trades, and then he hits a good trade, but he doesn't follow that trade to the end. He gets out too early, and so maybe in the morning he gets 3 or 2 or 4 times 10 pip loss, and at the afternoon he makes a profit of 40 or 50 pips, and all losses at morning are covered with that trade, but there's no gain out of that trade. Maybe if he's lucky, he's flat, but in most of the times he will lose money, and so this trader will lose in the long run.
So let's have a look at a practical example of a loose passive trader. and let's talk you through that. So what we have here is, and the financial instrument doesn't really matter, but for the people who are interested, this is the German DAX on a 1 hour chart. And what Daniel has kindly included in this chart is already kind of a line of interest, a line of significant support and resistance, right?
That's a structure level where the market stops, or
where the market definitely builds structure. And one example here could be that the market kind of has a level here, it gets tested at support again, breaks through finally, makes one attempt at testing it at resistance, gaps down, gaps up again, and now hangs here at that trend level. Fantastic, right? And in many traders' book, that would be a nice inverse scenario, and we would go short all in, right?
Right.
Why not? Let's see what happens. Boom. The market gapped down again and then crawled back exactly to this area of interest.
It does. And then what does it mean? If it's not short, it has to be a long trade.
Has to be long. Let's hit it hard on the long side.
And so the market just oscillating around that area. And that's some typical situation where most of the traders lose money. If the market goes sideward, there's a typical scenario to lose money.
I call it often being out of sync with the market. So you start being on the wrong side of the market, and as you rightly said, if it's not a short, then it's a long. And then you're out of sync again, and then it's probably a short, and then you're out of sync again, and you just completely lose the belief in your ability to trade, which typically then also has a very negative impact on your emotional capital, right?
Right.
So that draws down your equity in the emotional capital, which is very, very hard to rebuild, because if you don't trust yourself, how are you going to execute diligently that trading strategy?
And there's another factor. It's a 1 hour chart, so you've to count the candles. It's a long period of time where the market just don't do anything. It's moving a little bit up, it's moving down, and so the discipline is what you need. That you don't get into the market long short. So you have to be patient to wait, and that's what most traders can do.
Which is not easy. I think if you take the example of a 1 hour chart, and I look at the dates on the bottom, if that box disappears in a second, but you can see that it's days, right? It's the 21st, 22nd, 25th, 26th, 27th, 29th, 1st of February. We're talking easily a week, and you tell me I should be patient and not trade, or what are you telling me?
That's the secret of trading, and that's what most traders can do. They think, I'm a trader, I have to do trades, but that's not the point of success.
I guess probably another point worth mentioning is when you trade with Valutrades, you have access to a large range of financial products, right? And if the appropriate pattern or scenario doesn't emerge for you to take a trade, then you either look at another currency pair or a financial instrument that you want to trade, or you don't, as you said. And I think I heard you saying, sit on your hands.
Sit on hands.
It's also a position, right?
That's one of secrets to success in trading. Sit on hands.
Let's see what now happens to our loose passive trader. So the poor guy kind of got caught up in a couple of trades up and down. Each trade maybe a couple of points losses, and that adds up, right? So not a good position to be in. But hey, here it comes. The position now turns.
We get into short.
And we hit it hard short. We hit it.
Bingo.
And bingo, it worked. Yay! Again, market structure, as you like to point out, right? So we have a clear target from a previous low. We hit that again. We failed to print a new lower low, and probably he's already thinking about the range trade that is coming ahead, right? Like we can now stay within this range, and we just trade everything that hits the lower trend line long, and everything that hits the higher trend line.
But we locked in some money. It's good. So
we locked in some money. That's the point, right?
Some of the losses are covered at the moment.
Yeah.
That's good. So we can look up for long.
Yeah, fantastic. So we end the trading day with a couple of points plus.
Yeah,
So what happens next then? Let's see how the markets then continue to behave. Ooh, could have worked better. So what's the point here?
the point here is that you really should go with the trade if you're in the right direction. Don't get out too early. Make an analysis that helps you to find the right point to get out of the market, and just help me. Just don't.
Yeah. So you want to milk that trade, right? So the point is,
right,
you've been bounced around by the markets, up and down and up and down. Basically, I think what this is telling me is this guy is looking for a trend, right? And trend traders should know that you get stopped out more when you have successful trades, but the disproportionate successful trades will make up for the losers. And what just 1 second, what really kind of freaks people then out is that, again, coming back to this emotional capital point, you get to the lower trend line, you realize your profits, and then the markets moves on, and you think like, what if, right?
Yeah, right. What most traders don't know, the markets are in trend only 30% of the time. 70% they go sideways, and that's a hard thing. I can just tell it again. Be patient.
Which I think is fair to say also when you look at this chart. We have on the top left we have one shift down, right, and then we range, and then on the bottom right we have one shift down, and then we don't know if we range, but I think it's fair to say that in most cases on this chart we are in range mode, but still clear it's not easy to trade these kinds of markets, right?
No, it's not easy.
Okay, now I think that so we now covered sufficiently the loose passive guy, and again I probably see a lot of traders do that. Let's have a look at the next one. Who's our loose aggressive guy? What's the characteristic of a loose aggressive trader?
Yeah, he's loose in his trades. That means that he does a lot of trades, and he's really aggressive. That means that he has a higher position size. He can't wait, and he want to get into.
Yeah, well, I'm just taking this R out.
All right.
There was one R too many.
He gets into the markets with a too big position size, and so he can do good if he's very lucky, but often he fails. He's one of the trader that's first out of the game, and yeah, I think it's better if we take a look at it.
Let's have a look at a practical example, right? Oh, that's a big candle.
It's a power candle, or how we call that in English?
We like to call it a thrust candle.
A thrust candle.
It's
okay.
like a rocket ship taking off with a lot of thrust.
It is definitely. I think it's DAX again, and it's 100 and something, 180 points. That's real massive moving up in that market, and what could that be? The markets only could go up if there's such a massive buying in the markets, isn't it?
Yeah, absolutely. Look at this, like the low of that candle doesn't even have a wick.
Nope.
So this thing only went up, and we have a tiny wick on the top side. So that means we must have followed through. There's no other option.
So we're waiting and buy market next bar open.
Hard, yeah. Let's hit hard
so
long.
Good position size. We get into. What happened? But it's only a correction wave, isn't it?
Yeah, it's probably just a 50% FIP pullback, and we'll probably see higher highs soon.
Maybe, or it's a twin Elliott waves. So markets will go up. So we use that chance to get into the market with second position to get a better entry, don't we?
Yeah, absolutely. It's just double up.
Yeah.
Ouch.
But that's a part that happens very often. So people try to get a better entry by buying correction or what they think it is correction, and we have a lower low at that point. So this would be the point where the trader think about getting out of the trade. He's in the market with a higher position size. First he saw the rocket candle, now the thrust candle, and he has a good position size. Then he tries to get a better entry and double up the position. So he's very much investing in the market, and so the low shows him to get out of the market. That's a scenario that often happens.
I think that's really a good one, just to reflect on that for a second. So again, we have this thrust candle up. We think the market can only go higher. A bit like our loose passive guy also thought,
yep.
right? We hit it because we are aggressive. We hit it again on the pullback, and when we are doomed because the market turns really massively against us, we have double the risk, and that's a typical Friday afternoon trade, right?
It is. Yep.
Where you even then keep your position over the weekend and you expose yourself to event risk until Monday or Sunday night when the currency markets open again. Or in this case, DAX would be when the Monday morning open. So classical recipe for disaster and blowout trade that is really hard to recover from. So I think that's an excellent that's really an excellent example that you picked.
So you have the structure level here at that market, and if it's not long, it has to be short. Market breaks through that structure level, and so we try a short. We have to cover up the losses we made, so we have a very high position size at that moment, don't we?
Martingale, double and upping,
right.
Ouch! Now on the other side.
That's what happened then, and so it's very important. I can tell it again, sit on hands, be patient, wait until a clear sign for entering the market comes up.
I think that's some really powerful insight here, right? How patience can pay off. And when you look back at a chart and it all looks so simple and easy, but it's not, right? And I think we can agree on that. I think what I learned from this is don't go in too early, too aggressive. If you're wrong, don't be so stubborn that you just double down on it, right? And when you've lost money and you try to then double down again, this is really horrendous. Because as we know from martingale strategies, if you double down like between 5 and 7 times, your account is gone, regardless of the size of your account. Even if you had a million account, if you double up and double up and double up, it's empty.
So then it's a perfect example to tell people the second double up. You should ask yourself at any point of the trade if you would go into the trade again at that moment. You do that, and why should you go into a trade again if the trade is not going into your direction? If the trade is running against you, why should you go in again?
Right.
So that's a time to get out of the market. Because every point every day there's a point you have to accept that the analysis you did is not correct, and so that's a point you should stop out the trade.
So and I would put that together and say if the hypothesis, your market hypothesis is wrong, then you should really find a way out of the trade, right? And what I've seen many times is that it starts as a trade, and what you see here again at the top of that thrust candle long. And at a correction, another long, and then the market goes against you. And what I've seen time after time after time again is that when people stay in these positions, and what was their analysis, which maybe is valid, right, turns into hope. And when the markets go even lower, then hope turns into praying, and that has never helped. So I've seen a lot of people in financial instruments like silver, for example. Same happened. Silver was really pronounced, where people went in and just bet the whole account basically at the end of the day and just let the whole thing run. And you can only lose because you also have transaction cost if a position is open and you have to pay some sort of transaction cost.
Hope is no strategy.
No, that's probably something. And praying is something we do in church. It's no place in trading. All right, so I think that's quite fascinating. So this little fella is holding his, I suppose, his mum's leg. He's tied passive. So what's unique about him?
That's one of the better traders. So tight means that he sit on hands, that he wait until a clear sign comes up to get into the market, and passive means same, that he does not go on with big or too big position size into the trade. So he's one of the best or one of the good traders, and he could do he is doing good, but he could do better.
So tight. Let's just confirm that for everybody. Tight means that you have tight risk management, you have tight position management, money management.
Yeah, first tight
Does
means...
tight also mean that you always, a lot of people ask me about trailing stops.
Yeah.
Does that also mean tight?
Tight in this subject means that you don't go into the market too often. That you wait for your clear chance, for the clear entry you have, and don't go in, out, in, out, in, out.
Yeah.
That means tight.
So that's the sniper idea again, right?
It is,
so
yeah.
You lie on the top of a building and you just wait until your opportunity emerges, and then you go for it.
And you don't move before that.
Right. So let's have a look at an example that you put together for us. Again, I think it's the DAX 30, the German index, on a 1 hour chart in April. So what are we seeing here?
It is this trader does his analysis. First, he saw we have a trend, or we have a short. If you go to the next slide, he saw he sees the short, he sees the structure level, and he doesn't get into the market too early. He does the analysis first, so he figured out the structure level, waited until the market comes up to that structure level, and then he doesn't jump into the market too fast. But he's waiting until there is a breakout out of that, how you call it, trading box or out of that box, and then he gets into the market. So first he analyzes what happened in the past, then what do we have now, and then where's my chance? And the chance is there. He gets into the market, and the market goes in his direction.
So just to confirm, so he did his analysis, saw the structure in the market, highlighted by this red line, horizontal line. And only after we got some confirmation and we have this breakout to the upside, we got in the market around 9,800 in this example, and then waited all the way up to 10,072. So now we have a gap down to 9,970. What happens with a tight passive guy?
That's the thing that the DAX does very often. So DAX is known to gap in the morning at the opening. And so this guy doesn't know what happened now, so he gets a little nervous and he thinks, better close this position before losing all the profit I made with that trade. And you see the gap is it's a good, quite 100 points.
Yep.
So this makes him very nervous. So he closes the trade, money on the hand.
Yeah.
That's what he says. And he closed the position with 170 points. That's a good trade. He can live with that trade, and he did all good. Yeah. There was nothing wrong with that trade.
Yeah.
But the other thing is, if he would have waiting a little bit and did the analysis, he maybe could have the chance to move that trade on to, how you call it, mag the trade.
Yeah.
And it would have given another 400 points.
So again,
he's tight.
Yeah.
He's passive, and that's what it is. He's too passive. He's in the right direction, and he doesn't use all the chances he has.
Yeah, but we also know it's hard enough to get into a trade, and he probably also has had a lot of situations where the market gapped down and then followed through. Right away to your entrance, and then you think, oh God, it happened again.
Again. And money on the hand, that's what most people think in that moment.
Yeah.
Better that than nothing. And that tight, aggressive type, that's nearly the same one.
Yeah.
We have all the things before, analyzes the structure level, identifying the entrance, but then this guy is waiting.
Yeah.
He's waiting. What happens now?
Yeah.
And he maybe uses this little correction to get into the market with the 2nd position.
Right.
So, and that brings him another 300 foreign points
Yeah.
in the market, and that means aggressive.
Yeah. So just to clarify for everybody, I translated the whole deck and I failed to translate this particular slide. So Einstieg means entry at 9,800. The market moves up, gaps down. Zweite position is nothing else than second position, the one with a question mark. So this guy then adds up at the right point, but in hindsight, and take advantage of the whole upward move. So I think that's a really interesting theme. So he's adding to his winners, right, and not to his losers.
Yes,
and the others we've seen will probably more being seen as adding to their losers.
Always add if you're in a good position and if the position runs in your direction. Never if it goes against you. Never ever.
And let me make a clear reference also to another webinar that we've done, or also with Paul Wallace, on adding up and kind of creating a bit of a trading pyramid. And the idea here is just to give you the key themes, and the recording is in the Valutrades archive, is that kind of the further the move goes, the less you add onto the position, right? So you don't just get crazy and add at the top larger position sizes, but you just, the further you go, the more measured your addition will be to that position. But again, my reference would be here to a specific webinar that we just have on that topic. If you can't find it, that the colleagues at Valutrades know, we're very happy to show you where that is, because I think that's really the art of trading. Once you have a winner and you can squeeze and milk that winner, that can get you in the right position for a long time in your trading.
There's a saying, forecasting a price is a science, but trading is an art.
Yeah.
And that's it. If you can add up positions, it's a real art.
Yeah.
It's the art of trading.
Before we summarize, and I'll just check if we have any additional questions, let's just look at the types that we've discussed, and what would you say? Let's remind us again, who's the best trading type?
The goal should be to become tight and aggressive at the same time. To be tight means only go into the market if you have a clear sign, if you have a clear setup, and aggressive means that you top up if there's a chance to, but only if you're in a winning position. Never top up if you're in a losing position to get a better entry. Sorry.
I think Paul Tudor Jones once said, only losers average losers. That means that he would never add to a losing position. He would just take the loss. And if you, by the way, if you are really good with Google, try to find Paul Tudor Jones and his documentary of a futures trader in the 80s. I've recently saw it on a Japanese website. It's definitely worth looking at, because they followed him on his best trading day and they followed him on his worst trading day.
Okay.
And I think that in the context of the trading styles that we just discussed, will tell you a lot how a very tight, aggressive player plays it at a size that we probably at this table and also in the audience will never be in our trading, to be quite honest and transparent. But it's quite compelling and interesting to see how these characteristics still apply today, even in an era of electronic trading, where you think the whole emotion piece should be taken out. All right, let me just drive the whole thing home by summarizing, having a look at questions. Let me just see, where is this? Oh God, where is this thing with the questions? If you have any questions, I'm trying to find them. As a chat, no questions. All right, brilliant. But everybody seems to still be in the room, which is great. So let me just summarize and bring this home. And again, if there's anything, you can still type it into the chat. So we started talking about the need of preparation, you know, and the need to have rules, and the need to prepare. And Daniel kindly gave us some insight into his preparations before he goes into a trading day. I think that was quite powerful. So looking at the macroeconomic factors, looking at news, and just go to the Valutrades news calendar and filter out what's relevant for whatever you're trading. You don't need to look at absolutely everything, every event. You know, if you're not trading the Canadian dollar, you don't need to know what the BOC does, right? But you trade the let's say the Australian dollar when you want to know what the Royal Bank of Australia is doing, right? So that's simple stuff, one would think, but so important. And when we quite quickly then transitioned into these trading styles, right, and talked about the loose passive, the tight aggressive, the loose aggressive, the tight passive trader, and hopefully the idea here is that you take a little bit of time and you reflect on these trading styles and see who you are. And I think we've been quite explicit also in the terms of the potential outcomes of these trading styles. And typically, becoming a better trader starts with just being able to reflect on yourself, right? We don't try to be kind of the teachers with the kind of the rulers or the kind of the fingers high up in the air to tell you who you should be. We can just offer you based on the experience what the better trading styles are. And look, and I mentioned it before. Valutrades has cooperation with Chasing Returns. I think they're also really good in helping you with the analysis in trading. If you have not seen them, again, ask either your client representative or go to your client section on the Valutrades website, because that's some very, very powerful analysis where you can learn a little bit more about your own trading style and your own disposition and your unconscious bias and mistakes here. Any final thoughts from you, Stanley? Or
just one. Be honest to yourself by trading. That's a key point.
I think that's a really good one, and I think it also ties back into create a bit of accountability. Be honest to yourself and have somebody else you're honest to, because we as humans we like to kind of lie at ourselves, and
we do, yeah.
And think about the things in a way where, without getting too esoteric, but we like to think about things in a bit of an idealized way. And I've always learned that working in a team and getting some feedback is probably the only way to become better. And that probably also applies to trading, which essentially can become a bit of a lonely job. So hopefully we helped you on the right path, and it was a kind of encouraging 60 minutes. I'm sure we can continue on this theme if you guys like that kind of trader interviews. We can get Daniel back. We can also get other people involved in this. I like that very much. Makes it a bit more interactive and hopefully fun and enjoyable for you to watch. I'm already looking forward to the webinar next week, and I'm sure we will send out an email to remind you of the topic and hope you join us then. Thank you very much, and have a nice evening from London. And again, thanks, Daniel, for joining us here.
Thanks for having me here. Bye. Thanks.